Accrued expenses are another type of adjusting entry. What we're going to be recording here is the amount of expenses that have been incurred because you've consumed a service, but you haven't yet paid for those services, or maybe you haven't even received the bill. But here's the deal. The expense recognition, the matching principle, says you have to record all expenses incurred that helped you to generate revenues, even if you haven't gotten the bill yet. You have to estimate them sometimes. So all expenses incurred to help you generate revenues must be recorded in that same accounting period. But more simply said, if you've gotten the service, you've got to record the expense. So let's go through this adjusting entry where we have par for the course owes interest on its 6% notes payable. Well, what we have to recall is that interest is calculated by a formula, P times R times T. Again, P is your principal or your notes payable balance. Now, earlier we had par for the course, and it had a notes payable balance of $19,000. And we get that right under liabilities. You'll see notes payable $19,000. Now, as far as the notes payable goes, the amount consisted of 11,000 beginning balance, and then what they did is they borrowed another 8,000. So that's how you get the 19,000. Now we can combine these two, and that's because of R. The R is the same for both of them. The rate, which is always an annual rate, you have to be careful about that. So even if this, say, were a 3-month note or a 6-month note, this 6% represents how much they will incur within a year or for the year, even if they don't borrow for the entire year. Now, as far as T goes, that's your there's your 6%. Now, the last thing is T is time. And here's the thing with the time. We don't want to record a whole year if a whole year hasn't gone by since we've last done our adjusting entries. And in this case, we're doing monthly financial statements. So we're making an adjusting entry for the month of May. So we don't want to record a whole year's worth of interest. We only want 1/12 of that. That's the amount incurred in May, or 1/12 of the annual rate. So you would multiply again your P, your note payable balance, times your rate, and that's per year, times how much of the year you're recording for these financial statements, and it's only $95. So what do we debit and what do we credit? Well, we're getting a service. The bank is lending us money, so we will debit interest expense, because expenses are recorded when you get a service. And the matching principle says we have to record that even though we haven't paid for it. The fact that we haven't paid for it, what we're giving out in essence is, what we're giving is a IOU, and that will increase our liabilities. So we'll post these to the ledger by debiting interest expense and crediting interest payable. We end up with our ending balances in our accounts. Our amount we owe now is $260. You still owe $165 from the prior period, and another $95 for the month of May, for a total of $260. $95 of that $260 was incurred in May. As far as now financial statements go, you prepare your income statement, and that's over here under shareholders' equity. You get your revenues minus your expenses. So this expense here does not tell you what you paid. It tells you what you've incurred, the amount of service consumed. It will not equal your cash paid on your statement of cash flows, because you didn't pay $95. And then the difference is going to be you did not pay $95. That's zero. The difference between your balance sheet and your income statement basically is going to be explained as interest payable, and it's the amount you've incurred that you have not yet paid. So again, income statement and then cash flows, which is over here. Even though you don't see the cash account, that's where you'd be getting the information for your cash flows. They aren't going to be the same. And that balance sheet account, interest payable, will link the two together, explaining why they differ.